It's no secret that real estate can be a great investment, but real estate also has a handful of other great benefits, such as helping you save money on taxes once tax season rolls around every year. I personally have a 3-flat rental property here in Chicago and have seen all the savings on taxes from real estate firsthand. Today we're talking to Shauna, otherwise known as the Tax Goddess, all about how to save money on taxes when it comes to real estate investing. Shauna and her global team of 65 specialists use plain language to help business owners, investors, and entrepreneurs create plans of actions to increase their bottom line. With over 24 years of experience in implementing innovative tax solutions, Shauna has continued to actively create tax strategies that so far have saved businesses and individuals to the tune of over $525 million. She has been featured in a handful of media platforms such as Forbes, CNN Money, Entrepreneur, CBS, Fox, ABC, and many more. Now let's jump right into the interview. All right, awesome. Now we're going to jump into the top 5 ways real estate can save you money on your taxes.
Love it. This is one of my favorite subjects, Kevin, so I'm so glad that you brought me on for this. So real estate is a huge, broad field, right? We can be talking about Airbnb, VRBO, we could be talking about long-term rentals, we could be talking about real estate from a rental standpoint on the IRS view, also includes, like I've heard you mention Turo, okay? That is considered a rental. It's considered real estate from the eyes of the IRS, which is a little weird because it's a car, but whatever, right? So big things you need to be looking at with real estate. Okay, the very first one is, do you qualify, you or your spouse qualify as a real estate professional? This is a huge opportunity because if you qualify as a real estate professional, your real estate is looked at as a business rather than looked at as passive. And that's a big distinction in the world of the IRS. If it's a business, we get all the 400 business tax strategies that we can use, right? I mean, there's hundreds of these things. If it's passive, you're potentially limited on how much losses, even if we created tax losses in your rental business, you're limited as to how many of those losses you can actually use to offset something like a W-2. So in a perfect world, it's my favorite combination in the tax code. You have a real estate professional as one spouse, and you have a W-2 employee as the other spouse. That combination allows for any of the business deductions or expenses or anything that happens on the real estate side to effectively wipe out completely the taxation on the W-2, like to zero, right? So it's fabulous. Now, technical qualifications, I'm sure that's the next question on your mind.
Yep, yeah, that was going to be the next one. What do you need in order to qualify to be,
Two particular pieces. The real estate professional, so not the family, but the actual real estate professional person has to spend at least 750 hours on their real estate. Okay, so that could be managing, it could be calling the plumber, it could be searching for new properties, right? It works out to about 15 hours a week for all 52 weeks in the year, okay? And two things, and they have to spend more time on real estate than they do on anything else, okay? So if you've got a husband and a wife, and the husband's spending 40 hours a week on his W-2 job, and the wife is spending 10 hours a week on a part-time job, but 30 hours a week on real estate, we qualify both things, right? More on real estate and more than 750 hours a year. So those qualifications, now the IRS is specifically hunting that right now, okay? So be warned, don't try to be a real estate professional, actually be a real estate professional, okay? One of the biggest questions we get on that is, do you need to have a real estate license? You know, do you need to be an agent or broker? No, you do not. You only need to meet those two qualifications. So 750 hours and more time on real estate than you have on anything else.
Okay, that makes sense. And I've heard stories in the past too, people working a full-time W-2 job, but then claiming they're also a real estate professional, even if they have more hours, but I heard it's a nightmare because then you have to keep track of all the hours. Is that pretty accurate then, that most likely you're not going to be able to work a W-2 and be a real estate professional?
I mean, listen, maybe if you have some disease where you never sleep, sure, right? But most of us sleep at some point in the day. Yeah, trying to beat that hour requirement, spending more time on real estate, is very difficult as a full-time job. So it's part of the reason why it works so well if you have two people married, participating in the tax game, right? Because one of them can qualify and one of them can go be the W-2. So.
Okay, that makes a lot of sense. And my one other question is, when you're talking about if you're not a real estate professional, you're capped at a certain amount. Just to clarify, I believe that's $25,000. Is that correct?
You got it. It's $25,000. And so really what that means is if you have 3 rental properties and each one of them has a $10,000 loss after your expenses and depreciation and all of these things, the maximum you'll be able to deduct is $25,000. And even then, if the rest of your income goes up, that $25,000 starts to chunk down. So when you get over, I believe it's $150,000 of joint married filing joint income, that $25,000 goes to zero. So you have to be very cautious about that. That's what's called an active real estate investor. And then the third category is passive, meaning you don't do anything on your real estate at all and you get no tax deductions of any kind.
But yeah, I think that's a great tip. What about any other tips as far as saving with real estate?
I love it. Well, especially if you are considered a real estate professional or the active, that middle category. One of my next favorites is something called cost segregation. So if you look around the building, so can I pick on you, Kevin?
Yep, yeah, definitely.
Okay. So if you look around Kevin's office here, right, he's got some lighting and he's got some wiring for his computer and he's got some maybe dirt or a panel or something with the cool leaves, right? So all of those pieces are pieces, right? They can be segregated from the actual building itself. And even within the building, you're going to have drywall and flooring and, all sorts of pieces, door handles, all sorts of pieces to the building. So when you are either a real estate professional or active, and with active, of course, you have to meet those income limits. If you qualify, you can take something called cost segregation, which takes the entire purchase price of the entire building. So if you bought something for $250,000, it would break that $250,000 into its components. So it would actually say the drywall is worth $10,000 and the floors are worth $15,000, et cetera. Now, why is that important? Different components have different depreciable lives, which means normally, for example, on a residential rental, you're depreciating everything over 27 and a half years, evenly, 27 and a half years. If you do cost segregation, you can pull a bunch of that depreciation really early into you owning that property, meaning you get a much bigger tax deduction and hopefully, therefore, much less taxes that you have to pay. So it works really, really well, especially if you're that real estate professional category.
Okay, yeah, I think that's a great tip. And it's kind of just speeding up, like you mentioned, the depreciation history of how fast you're depreciating things. And that's something that, I personally did for my 3-flat here in Chicago. We did a cost segregation. And instead of doing the 27 and a half, like you mentioned, really sped up the process. And especially with me renovating 2 to 3 units, it was a big money saver for that year in taxes.
Absolutely. Yeah. And offsetting all of the house hacking income that you're getting is even better. So get free cash and pay no taxes. I'll take it all day. So
definitely. Yeah. What about moving on to our next tip? What else would you say is a great way to save with real estate taxes?
So one of my other favorites, of course, is to keep your eyes open. Now, sounds like that's a very broad kind of thing, but what I'm specifically talking about is keeping your eyes open not only for a deal, right? So when we're talking about real estate, of course, you make your money on the buy, right? Which it doesn't sound like taxes, but it kind of is, because at the end, when you sell the property, one of the things you're going to have is capital gain, potentially even ordinary gain, okay? Generally, you want to fight for capital gain, which generally means you've held on to the property for longer than a year, okay? But one of the things that bites people, and kind of go back to that depreciation, one of the things that bites people when they sell a property and they didn't know it was going to bite them is depreciation recapture, okay? Definitely. So keep your eyes open. Yeah, Kevin knows. He knows. He's seen this one. So there's 2 things really that you want to watch for, okay? The first one is my gain going to be capital or ordinary? Okay, so if you can get it to longer than a year, capital is good. Generally, the rates for tax on capital is lower, right? Maximum right now is 20% at the federal level. There are specific tax strategies when you're selling a big thing, like a piece of real estate, to get you out of paying tax on any capital gains whatsoever. Now, one of the most common ones is something called a 1031 exchange, okay? Most real estate people know about that. You're exchanging a piece of property for a piece of property. But there's two others that are not quite so common and some of my favorites. One of them is a 721 exchange. So if you like real estate, but you no longer want to get that 2 a.m. phone call that the toilet broke, okay, you can exchange real property for interest in a REIT, R-E-I-T, Real Estate Investment Trust, using Section 721. So that's another way to get out of property but not pay tax. And then the third way, well, I guess there's 4 ways. The third way is using an opportunity zone. So you can sell your property, take the capital gain, put that money into an actual opportunity zone investment or into an opportunity zone property, and you get to defer the tax, and there are some special tax credits for that kind of thing. And then the fourth one is something called a DST. Now, the DST has an East Coast version and a West Coast version. So the East Coast version is the Delaware Statutory Trust. They're good. Not my favorite thing when it comes to real estate, but they're good in certain circumstances. Okay. The DST West Coast version stands for Deferred Sales Trust. And so if you want to learn way more than you ever wanted to know about it, you can go to DST, the number 4me, DST 4me. We've got webinars and all sorts of things. But effectively, you can sell your real estate and invest in anything else you want to. Cryptocurrency, gold, classic car collection, anything, and it still defers the tax. Even invest in another business. So you sold your real estate, but you want to open a Subway franchise. You can do that, okay? Now, with all of that being said, we still have yet the depreciation, okay? Depreciation recapture is not capital, it's ordinary, okay? So this is what tends to bite a lot of real estate people. If they haven't been warned by their CPA, they get an extra bill for depreciation recapture that they weren't expecting. And ordinary tax rates at the moment, the highest tax rate in the country is 63%. So a huge difference between that 20 and the 63. So you definitely want to be working with your CPA, with your tax strategy team, to make sure that if you're going to get hit with something like that, you know it's coming and you know how to solve it. So
definitely. I think the biggest thing is always trying to be prepared. And I feel like a smart move is always talk to your CPA or accountant before you make any big changes, before you sell your property. If you're thinking about doing it, reach out, see what the best strategy is, and then go from there.
And make sure you throw into that group. So yes, you've got your bookkeeper, your CPA, but also your tax strategist. Those are completely separate people, right, that do specifically this. So make sure you're getting the whole team, your financial advisor, real estate attorneys, all the people in the team on the same page when you're selling something.
Definitely. Yeah, it's really interesting. And I feel like, yeah, in the real estate world, a lot of people talk about the 1031 exchange, but like you mentioned, it could be a lot more headaches. There's a lot of red tape that goes along with it. But yeah, I didn't know about the 721. I feel like that's in exchanging for, say, the other one for cryptocurrencies and other investments and businesses. I think that's very interesting. So
my pleasure. That's exactly why people call it goddess, right? We know all the fun strategies. It's good stuff.
Yeah, definitely. That was, a great tip. What about, do you have any other, I guess, creative ideas then that people should be aware of?
Well, I suppose so it depends, of course. Every answer in my world, Kevin, is it depends, right? So are we talking about the real estate professional or are we talking about active? Either way, okay, the real estate professional, of course, we can now look at this as a business, which means we get all the business deductions. So paying your kids, master's exemptions, defined benefit programs. I mean, all sorts of cool things we can do if you own a business in real estate. But even as active, making sure that you're actually hitting that 25,000, right? That if your deductions are currently at 14.9, let's pay the kids 10,000 to get to 25,000, right? Let's try and take advantage as much as we can to get to that 25,000. And on the other side of that, also managing your taxable and adjusted gross income numbers, because if you go to 150,000, $1, you lose all 25,000 of your income, right? Of your deductions. Wow. So very, very important. Again, speak with your CPA, speak with your strategist, right? Make sure that your numbers are crossing those T's and dotting those I's, because how frustrated would you be if you made $1? I've had it happen once, wow. $1 over the limit, and it wasn't expected that you lose all those deductions. It's pretty heart-wrenching.
Yeah, that really is. You definitely don't want to hear that situation when you're doing your own taxes.
So yeah, I mean, real estate is, about 40% of our practice. So there's a million ways to skin that cat. And it really, honestly, the answer in our world is it depends. Just depends on what you're looking for and what you're trying to do. And what are you building? Are you building a legacy for your kids? Are you just trying to get some passive income for you to have for retirement purposes? As you said, are you trying to house hack? Are you trying to pay off your mortgage by having other people pay it? 16 different ways that you can look at real estate. It all depends on what you want.
Yeah, it's true. Definitely. Everyone's strategy, everyone's end goal is different. So how you get there could really affect, your strategies and what you do.
Absolutely.
Awesome. But yeah, I don't know if you had any more tips, or do you think that was
Probably the big ones. It's, then we start getting into the specialties for each person. So definitely, if anyone has any questions, don't hesitate to reach out, taxstatus.com.